Hello everyone, welcome back to another video. In today's video, we are going to discuss why we look at low volume nodes as rejection areas, or rather why we prefer the low volume nodes to take trades off, or the pullback trades, or let's say the aggression trades, or whatever you can call it. So it was a request from one of you guys where this question kept coming on, the question was, why do I prefer low volume nodes and why do I not prefer the high volume nodes to take trades? So the question I will just illustrate so that we can move ahead and then discuss what the essence or what the importance of low volume or high volume nodes are. So it's not only that I prefer low volume nodes, it's just that I look at the context as well along with this. So there is no simple answer to this, but the low volume nodes, we will just discuss each and every one of these in the last 3 days that you have had, and the trades that you could have taken off these, and why why does the high volume node not come into my consideration? It is not that, it is both of them have a role to play, but again, depending on the context and depending on intraday trades that we generally discuss over here, it makes a little more sense to take the low volume nodes as your reference point when you're looking at pullbacks. And you're sometimes there are traders who do not want to look for the confirmation candle, because on bank nifty, if you look at places like these, the pullback is really fast and you don't get time to enter, and by the time you look for a confirmation, it is, you lose. For example, let me show you one example that I want to show you over here. For example, there are places like these where the pullback is really fast and the confirmation is somewhere here, and you miss 50-60 points, but again, when it is coming here, you don't know whether the because this would be the second time the low volume node is about to be tested, whether it holds or not. So everybody has their own way of trading, and what I generally do is I look for a confirmation of the footprint. So that is why I have the footprint chart on. So for people who are new and who are wanting to know what I'm talking about, you can look at the last video that I've done on the volume profile series. That is 2 weeks back. It is the volume profile part 4, where I've discussed these low volume and high volume nodes, and I've discussed even the fixed range volume profile, why I take these trades and how I do that. So on the right hand side, I have the footprint chart. So the charts that we are discussing today is the bank nifty futures, and on the extreme right, I have the market profile. Don't worry, for people who do not understand market profile, we're just going to take glimpses of it. In due course of time, we'll have a market profile series as well, so you need not be bothered about what you see over here, A, B, C, D. What I'm going to show you on the market profile is just what I can't see on a daily profile chart, or rather a daily chart, so to say. So this just to make it clear, this one block that you see is a daily chart. So what has happened within the day is shown over here. So don't worry if you don't understand all these things. It is just to show the activity that has gone on that particular day. So to move ahead now, if you look at this chart, okay, so like what we discussed in the previous video, so the low volume nodes that we can trade off is this. So when the first time the market touches this place, you can take a trade here because it's a low volume node, and have this as a stop loss on if this is more just above the high volume node. So you can see what I'm trying to do here. This is a zone that was traded the previous day, okay, number one. Number two, what I have done is now, let's go on, and what I do is I rate it, or what I mean by having a context is I know that this area was traded, or there was some activity in the previous day. It is not something that is coming off as a new zone. By a new zone, let's say if this was an area that was being tested a week after, so for example, it would have gone down and maybe the next week it would have been tested. It was another scenario, but this is happening on the very next day. So I have my what do you say, reservations about this, but nevertheless, I'm going to take an intraday trade with not too many, expecting not more than 150-200 points. So yes, I will go ahead and take that trade. And the high volume node is, I will use this as to keep my stop loss. Why is that? Because if this high volume node, for example, would have been that strong, or there would have been a lot of activity, something like this, and the rejection of it would have been, let's say, a good 2000 points, okay. So over here I just see 300 points. I would have trusted this high volume node, but you see it has gone down and come back again. So this high volume node was not of the sort where a lot of aggressive selling or distribution that you call in some terms was taking place, because the pullback was not that steep, and then you get an immediate return to the POC for that day. So you see, the context here is that this high volume node, or the volume that has transacted here, was not so much so to take this market down by 2000 or 3000 points. It was to do with play an intraday play, that so that you could form another profile here, and maybe to found a to form a range bound market. So I can see there is these traders are a mix of intraday, and sometimes people call it the other time frame traders, or the higher time frame traders, and so on. So I know they are not that, they're not interested in taking the market down another 2000 or 3000 points. They're just interested in keeping the market within range. So that is why this high volume node, I'm not, I can't trust it. So, and you can see it the next day whenever it comes here to this, it does take a pull back from this POC and goes back. So this is another way to trade it. But if I have to take two trades in a day on an intraday basis, I would rather not trust this. When I get a trade, obviously I will trade it, because the first trade that I get is of this low volume node over here. Okay, so what I would have preferred, so you can see all three trades playing out on this particular day, that is the 15th of July. The first one being of the low volume node. If I see over here, so I would have trusted this trade when the market came here and had this as my stop loss. Okay, the next trade that came up is after some time. Let me just do this so that you can see all this. Okay, the next trade that came up is after this was on the POC. Okay, and which was my stop loss in the first case. Now I would not have been comfortable with this trade, firstly because I've already tested this area just below, it is not even 50 points below, and I have already got a good trade out of it. Now the second time this comes to the POC, I'm not trusting it, because there is some sort of volume that has developed already when the market tested this area. Although you do get a rejection, it happens, it sometimes doesn't happen, but if you've already got one trade of it, I wouldn't have preferred this. Don't worry, we're going to look into the footprint charts, and I decipher these points from the volume profile, and then I dive deep into the footprint and see what I've seen over there, and what do I see sort of a rejection happening or not. Okay, and I will tell you what I look at the footprint over there, and then we can see and we can discuss why the low volume nodes are better off. Now after this point, the market leaps off over here. Now what it does is it leaves a low volume node over here. Okay, now the next day, this is the trade that I'm looking for, and not this one. This high volume node is not what I'm looking for. Just pardon me for that inappropriate straight line. So I am looking for a trade somewhere here. Okay, and if you look closely, I do get my 50, 100 or whatever points. So you look closely over here, and my stop loss would have been somewhere here. So if I'm taking a trade here, let's say 580, 560 or sorts, or 590, and I have a 100-point stop loss, I'm expecting at least 100 points or 150 points. I get only 100 over here, and it comes here, it goes down to 560, anywhere where you take, and it gives you about 100 points, and the stop loss would have been somewhere here. Okay, so 60 to 80 points would have been my stop loss that I generally like to keep at the volume node, high volume node, or just below it. It again depends on the risk reward, and these low volume nodes do generally give you at least 1:1. Okay, and the probability is really high. You can go ahead and back test all of these. We'll try and do that. Now let's get into the part where we use the footprint chart. So this is how to set up these charts. I've already discussed. You can go and watch my videos over there. So let's first do one thing. Let's take out the imbalance zones from here, because this is a bank nifty chart, and you'll see a lot of cluster happening. So what we'll do is we'll take out the stacked imbalances over here. So I see a clean chart over here. Okay, so now let's get into this this session and discuss why I would prefer these low volume nodes. One is this one, and if you look closely, you have got very good trades of this one low volume node and the very next one over here. Okay, so both these trades, intraday trades, if you would have taken, you would have got at least 100-120 points in bank nifty. Okay, and now let's go into the footprint chart of 15th July, and if you see this whole thing starts from about 1300. Okay, so let's go to the 15th of July and let's see what was happening over there. So again, for people who do not understand footprint, there's a lot of videos that I've done on footprint. You can go ahead and watch them. Okay, and if you want to understand and we'll just discuss. We'll go to the 15th and 1300. So these are the candles over here, and let's come lower. Let's go higher. Okay, so this is what was happening over here. Okay, so let's go to 1300, and straight away when you see here and here as well, I see a pickup in volumes. Okay, so this is what was happening till the 1300. At 1305 I see a pickup in volume. Okay, so the low volume node is somewhere here at 15450. Okay, so let's see what we've seen on the charts. Okay, so firstly when I see this at 1310, okay, and you can see these markers or this cursor syncing both on both the charts. So now like we've discussed, look at these imbalances, and the volume that has picked up here, it's not much. Okay, so the bar that is of that becomes of importance to us is this one, the next one, and this one. Look at the pickup in volume. This is huge. Okay, 6,000 and 7,000 contracts. Now what we want to look at is how has the market gone up. Okay, now in all these scenarios, in all these three candles, I see the chunk of it being buying volume. Okay, let me do one more thing so that we can see the other side as well. What we'll do here is we'll go here, value label, and we'll make it gray so that we can see both the volumes. Okay, so what we see over here is, if you look closely, these are all 0 0 0. So this is by imbalance being created, and this is absolutely aggressive selling. So if you look at the delta, it is not that much, but if you look at where that positive delta has come from, is all from this area. Okay, this is the zone, and what I see in the next bar is what is important. I don't see I see some sort of selling come in and all of it fail. Okay, so these obviously would have been the stops triggered, but the people who have got this market up, okay, from lower point, and you see the speed with it, with which it is going, with the volume which it is going. So this is the first indication that yes, you have got some, although the volume did not pick up over here, and this one is the main one where you can expect some sort of aggression to take place if the market stays above this zone. Okay, it doesn't break this bars POC. All these imbalances are not broken and the market continues. All these sellers are trapped. And now let's get into the interesting part. Okay, look at this, where the POC is and where the maximum chunk of the volume is, somewhere here, and this is all positive delta. You look at this delta. Okay, it's 765. The delta has started picking up, and all the positive chunk or the aggressive buying is happening here. This is the place where the sellers try to come in. They have failed here in the bar, and I know if this is protected, I know this new buying that has come in will take the market further up and cause further stops to get triggered. And look at what happens in the next bar. Again, a lot of buying that has taken place, and the market moves up in one direction. Okay, now these points again, if you're a scalper, when you look at this, you try and enter because you've not seen any sort of absorption taking place. The absorption would have been all these the bar closing somewhere here, okay, below these sellers who tried to step in, and all these buyers getting trapped. If the bar would have closed here and the next bar would have started going down, I would have entered a short. But what I see on the other hand is sellers getting trapped on a big bull bar. A lot of buying aggression come in, and these buyers who have stepped in over here are not giving up. Okay, they've stepped in again, they've formed another cluster over here. Look at this, and look at the volumes of the bar, and look at the delta that has taken place, 3162. And now look closely where this delta is associated. Just don't look at the delta. What people generally, the mistake they do is just look at the delta. Okay, the bar of the delta is very high, this is positive. No, look at where it is and what the price is doing after that. So the big players who have stepped in here have not let the market go below this POC, okay, below this cluster of buyers that have gone in. The sellers that have stepped in have already failed. So probably these guys that have stepped in here as for selling, they're going to puke again. They're going to come out in this subsequent bar. The buying that has stepped in here, okay, has not been tested. The bar keeps going up and up, and look at what happens after that. Let me just delete it. Now the next cluster that forms is somewhere here. Okay, look at this cluster, the volume cluster. This is all buying. Okay, the delta that has happened here is in this whole place. What does the bar next bar do? Okay, just keep looking what happens. Okay, the next bar, again, it is not even testing this zone. Okay, this is the primary POC, this is the secondary POC. It doesn't even attempt to come at least till this point or this point where the cluster is. So if the buying is not that strong or little weak, what it will do, it will come here and then go up. And for scalping, this becomes a very, very good scalp. Okay, the area for getting a 50 100 quick 50 100 points move on bank nifty, this was the area. If the market would have pulled back here, this is a very good scalp, and then you could have seen maybe a consolidation. But this thing that tells us that there is still a move left in this market is, look at these areas in this cluster. It is again not tested. The market comes here, it just doesn't go even till this point or any point, and the market continues. Okay, now the first time we've seen some sort of rejection or some sort of setting come in is this bar. Look at this volume. Okay, so obviously, and there is a little bit of absorption that has taken place. Now this is a perfect bar to see absorption and the end of aggression and so on. So if you see what the delta over here is, it is just reduced obviously a little bit. So if you see the positive delta, this is the zones that are here that are forming this positive delta, or rather the buying that has been going on is this zone. Okay, the other one is somewhere this zone. Okay, and the next one is somewhere here. Okay, so some people would call this as absorption. No, I don't see it as absorption. Why? Because the numbers aren't that high at first. This is just, you can't call it exhaustion, but the buyers are not stepping in at this price at the moment. You can call it that. Exhaustion would be that the market comes at, it's sort of an absorption, but look at the context behind you. There is so much of buying that has come in. Maybe exhaustion for this bar where the buying comes in and there is no fresh buying, and the buying or the contracts are not high. Look at the difference over here. So these are a lot of contracts. So if the market would have gone down from, let's say, over here, okay, I would have called it, and the market, like I discussed in the previous bar, if it would have closed here, I would have called it absorption, because a lot of buyers would have been trapped here. Over here, nothing like this has popped up. A lot of buying is at the background. I see a lot of buying. I would consider a reversal of some sorts if the market would have broken this bar would have done this, the next bar would have tested this, gone up, and then when would have broken this, I would have considered a rejection or a reversal rather. And again, if the market would have come here, over here, I would have expected another good long or a scalp trade that we just discussed. Okay, now let's go here, and this is the first bar where I can see, look at the selling, some sort of selling that has started coming in. Now it has gone down and it is held up to this point. The volume POC is here. Look at what the next bar does. So this cluster was not broken in this 5-minute bar with high volume, and the next bar, if the market is to take a pullback, I expect it to break this. It doesn't break it. It leaves some very little sellers that try to take the market down, fail. And as soon as the market moves above this zone, because all the sellers are associated here trying to make the market, get the market down, you can again step into a long. Okay, again a scalp, not an intraday trade, because I am seeing these sellers are going to come out again. And look what happens, as soon as it breaks, it again takes these sellers out, and again there is a lot of buying that has taken place. This is one place, okay, where a lot of buy trick stops or whatever has been triggered, and this huge number, you can say there is a sort of absorption in a way that has taken place. And when the market starts falling and it falls below this, or it fails to go, you can again take a scalp to the exact same point. So you can see what is happening over here. If you start looking at these footprint charts, so this is the point which was a reference. The market has not gone below this point. Okay, this is somewhere close to 600. Now let's come to the volume profile and let's see all these points. What were these points? Okay, so if you consider 600, this was somewhere here. Okay, this is the low volume node. This is let's say 580, 590. So this is the zone we are talking about. Okay, this zone. So it is a carry from the previous day. It's a low volume node on the volume profile, and you can see exactly what has happened here. And this area, whenever the market tests on the next day, that is over here 580, that is why I was ready to take a long of this zone. If you can, I mean, what you can do is let's get this, and let's get a rectangle, and this is the zone. Okay, I'm talking about. So whenever I see the next day when the market comes here, I'm ready to take a long, and this was defended a lot of time. And of course, the next day when the market comes here the first time, you can look what happens. Okay, that same zone, I'm ready to take a, and I don't see on the next day this is a huge I mean red candle. So what you can do is aggressively or whatever, if you see some sort of, if you're scalping, you can enter late. But if you see the pullback of this zone 580 89, you can see a good I mean almost 100-point move to the upside over here. So these are zones that you can trust and take trades of. And after that, if you've not covered, again you can and even if you enter a stop loss, let's say you were looking for a 200-point move, or let's say you were at least hoping for something and you've not covered up, and you give your stop loss, the stop loss that we discussed would have been somewhere close to just below this high volume node, that is 530. Now you look at the place where we put our stop loss, that high volume node. So in a sense, what we're doing, as if I would have been looking at the footprint chart, my stop loss would have been this is one area where the buyers had stepped in. There is a good cluster, so I would have put my stop loss somewhere in this low volume node, 540s and 545s, because I am looking at the footprint chart, and precisely I'm looking at places where I'm where I know I am wrong if the trade has not gone into my direction. The next low volume node that I've seen here is at 440. Okay, and the market takes a support of that, and let's see what happened on this at 440. So okay, so again this is a place where we had discussed. Look at this zone. Okay, and this is the place where the market move had started the previous day. These candles had started from there, from this point. So we know exactly that the big player that had come in and taken the market in one direction over here is not I mean it is from the high volume node, but this is precisely the point I can see where he's shown in some aggression. So what we'll do is, in one of the videos in maybe the coming weeks, we'll discuss why these imbalances are created, and what happens behind the scenes when these and how these imbalances are created, and why these play out so well. So this is the second area that I would have marked, what we discussed in the starting of this session, why this area was important. And you can see it takes a very good resistance and gives you a good 120 points again. So you can keep doing this. Let's delete this, and we'll close this session after just discussing. Let me delete this. Okay, and let's play out a low volume node from the session that happened on Tuesday, so that it I mean it is of some help to you tomorrow. Now this day was a very highly consolidated day, and the low volume node that you have over here is this one. Now again, like I said, this is a volume that has already been traded. It has created a low volume node at the POC of the previous day, so I wouldn't trust it, but I will look at the footprint chart that is taking place. So you have an opportunity between 620 to 640 to short. Again, when you're looking at zones like these, okay, what you have to look at is what is your target, or what is your risk to reward. Obviously you would be risking at least 60-70 points. If you've taken at 640, 700 and 710 would be your stop loss if you've entered a short. That is if the market opens here, somewhere here, it goes here, and you're expecting a touch of this high volume node that is at 560. So you're getting 60-70 points against a stop loss of 60. So the max you can expect is 1:1. So you have to know this before you enter the trade. This volume profile is telling you that there was a consolidation area in the previous day. So the max you can expect is 1:1, or 60 points is the max you can expect. If it doesn't meet your criteria of risk reward, don't enter the trade. Now the next thing that can happen is which I've seen a lot of times happening is, after an expiry, is the market opens somewhere here. Pardon me for that. The market opens, this is the low volume node, the market opens somewhere here, comes here, takes a support and moves down. So this is another very good trade that you can take. If something like this happens, the market opening on top 700, and you trying to take a trade out of 600, your stop loss is again 540 below this high volume node. Okay, so the last thing we see is what happened on this day, that is 930, 935. Why this happened? So let's go to the again the footprint chart. So over here, now the difference here is this volume node has not been created by aggressive selling. I mean, there is aggressive selling, there is a lot that has gone in, but look at the difference in the two bars. There is this day, this selling that has happened is obviously there is aggression here, but look at the so much stuff that has happened within. There has been buying also, there has been selling also, then again there was a selling. So I see a lot of clutter that is happening here, okay, in this zone. That has left a low volume node. If you look closely, what we can do is we'll do one more thing so that it becomes easier for you to plot. We'll go here, go to this point. Okay, so the custom ticks was, you can generally have it at 100. This is the options tick setting that I'd set in, so you can have it at this as well. Okay, so what I see here is I don't see a lot of selling, aggressive selling that has taken place over here in this area. It is not a one directional move. See what has happened. It has gone like this, and this is commonly the result of the consolidation of the expiry date trading. So I have seen buying here, I have seen selling in this zone, out of which the market has taken, let me delete all this. So if you see, I have seen selling over here that was not tested again. Okay, and this is the zone that is that we're looking for to short, but again I have not seen anything substantially aggressive from the seller side. So this is the difference between this day and this day over here. So as I said, you can of course try and look at the footprint charts on Thursday, that is, to take a short, but look at what has happened, look at the context, look at what has happened the previous day, look at the footprint charts. Of course there's a lot of volume, but what has this volume done? It is, I mean, one blue, one red, one blue, one red, one blue, one. Look at the way the market has gone down. There is no clear winner here. So that is why I wouldn't trust this zone. So hopefully all these ideas that we discussed over here today, you could they would be of some help to you to find out good trading areas and know how these low volume nodes can be played. Until next time guys, thank you, bye bye.